Everyone. This week I want to talk about putting in the wrong trades. Thinking that you're executing an order for a certain company and certain stock and actually buying something different. I think a good and relevant and recent example of this is the difference between Zoom Technologies and Zoom Communications. During the whole lockdown situation, Zoom Communications, ticker symbol ZM, was a big trade. And then you have Zoom Technologies, ticker symbol ZOOM, which is not obviously Zoom Communication. And the thing is, many people bought Zoom Technologies, so much so that it shot up 1,800% for the year. And that's just incredible. Because you had the March lockdowns, and then from there upwards, now that's not exactly the best representation, but we're talking 1,000% return because people got the wrong stock. And worse yet is that many of these people didn't realize that they got the wrong stock, which is why you see this precipitous fall. And the problem with all this is now you've bought a company that you didn't realize was the wrong company, and in doing so, you've actually missed the opportunity of being invested in the company that you wanted that might have more iterative and sustainable developments to it. And when you finally realize that you're in Zoom Technologies instead of Zoom Communications, one might say you need to pivot and reposition into Zoom Communications, but at that point, you might ask, how much did it run up? In this piece, it says, it seems as though some people who thought they were investing in Zoom Communications, the real one, were actually buying Zoom Technologies. The other one, by accident. Those mistakes pumped the share price of the wrong Zoom up by 1,800% at one point. A tidy return to anyone who made the mistake early and benefited from others doing the same later. Now, I want to think, as we go through these, I would almost think that there must be some kind of an arbitrage opportunity, because one of the common themes among this is that when a company IPOs, another company that's already listed with a similar ticker symbol than what the IPO company is going to have and or similar to that name often I don't know, there's survivorship bias here, but that there is opportunities for it to ramp up. But I don't know. To try and minimize the confusion and protect investors, the SEC actually had to suspend trading in Zoom Technologies for a brief period. Now here's the real kicker. This isn't even the first time this has happened. When Zoom Communications went public in April 2019, uninformed investors also poured money into Zoom Technologies, which saw its share price go from less than a cent to almost $6 in about a month. So when Zoom Communications IPO'd, Zoom Technologies ramped up, and then during the lockdowns, everybody wanted to corner the float in Zoom Communications, and they accidentally did so in Zoom Technologies and pumped it up. Snapchat is another good example. Snap Interactive's shares have skyrocketed after eager investors confused the company with Snapchat. It was announced last week that Snap Inc., the parent company of Snapchat, had filed an IPO worth a whopping $3 billion. However, some overeager investors seem to have shelled out in the wrong company, buying shares in Snap Interactive, a public dating company founded in 2005 that runs flagship brand FirstMet.com. As a result, Snap Interactive shares soared by 164% in the 4 days following Snap Inc.'s filing for IPO, almost doubling the price of the company's shares. Snap Interactive stock is under the ticker symbol STVI, whereas Snapchat's will be SNAP when the company does IPO. This follows the news that Snap Interactive filed a lawsuit against Snap Inc. last October, arguing the company's use of the same or virtually same name was a trademark infringement and caused confusion between the two companies, which we just clearly demonstrated it does. And, I guess less savvy, unsophisticated investors, because when you put in an order, there's a few things you should do. you put in the order, you decide how many shares of something you want to buy, at what price, and you put in the order, and normally it asks you to confirm the order after you've put it in. And you should be making sure that you're buying and not selling. You should be making sure that it's the correct, both the company name and the company ticker symbol. And you should make sure that the shares are correct. And that the total cost, say it's a market order, is around the ballpark that you thought it would be. And then you execute the trade, and then you go back immediately and look in your portfolio and make sure that it's now in there, and make sure that the transactions filled it around where you wanted it to, so that way there isn't any erroneous errors in trades. But people don't do that. Then another one, Twitter, but instead of Twitter, it's Tweeter Home and Mobile Entertainment. On October 9th, 2013, so if you notice, we're going back in time. This isn't some new revelation of the trader bros around bad profitless companies in the 2020-2021 pump. So we started in 2020, and now we're here at 2013. So want to buy stock in Twitter? Don't buy Tweeter by mistake, or for that matter, Teeter. The social network juggernaut has yet to make its public stock offering, but that hasn't prevented over-eager buyers from trying to buy the shares anyway. Problem is, a lot of them have bought stock in the wrong company, Tweeter. The stock of the Tweeter Home Entertainment Group shot up almost 700% on Friday, the day after Twitter's IPO filing became public, as buyers mistook Tweeter's ticker symbol, TWTRQ, with Twitter's TWTR. What buyers bought were shares in a defunct Massachusetts retailer of electronics that closed up shop in 2008. Its stock today is traded only over the counter. So they're making another error. They seemingly don't have sense to recognize that practically any stock with a 5-letter ticker symbol is an over-the-counter stock. And then they might stop for a second and say, hold up, why would this brand new multi-billion-dollar company that's IPO in the over-the-counter market? You think that would stop people, but seemingly it doesn't, because, well, 700% would say otherwise. Now, of course, it's a small float, and therefore you can jack up the prices relatively easy. But, I mean, it takes a lot of traders, or one big trader, and on we go. Just about every time Ford Motor makes big news, some investors mistakenly buy shares of Forward Industries, a tiny maker of carrying cases for medical monitoring systems and other electronic devices. The reason that is because Forward Industries trades under the ticker symbol FORD, and Ford Motors trades under the ticker symbol F. And some more. HP is not the printer company or Hewlett-Packard Enterprises. HP confuses investors too. When either of the two tech companies that were part of the original Hewlett-Packard tech conglomerate are in the news, shares of oil service company Helmerich & Payne, ticker symbol HP, which actually trades under the ticker symbol HP, often moves in the same direction. PC company HP's ticker symbol is HPQ, while Hewlett-Packard Enterprises trades under HPE. And then it goes on to talk about things we've already discussed, so we'll skip that. And then I almost fell for this myself years ago. And I don't know how I didn't, but I almost did. An iPhone maker, Apple, and Apple Hospitality REIT, a real estate firm that owns hotels, are often mixed up. And I believe they made a mistake here, because iPhone maker Apple, I'm thinking off the top of my head here, is like APL, and then Apple Hospitality is like APLE. So even in the process, and I'm just noticing this in real time, so unless I'm getting something wrong here, but even in the process of them writing this, they make the erroneous error. So that shows how prominent and pathological it is. And then here's a common name ticker mix-ups. And in recent times, we've had the banking fiasco going on. And one of those banks that's in the headlines is Zion Bank Corporation, ticker symbol ZION. And I just can't, I'm kind of curious. I should have looked this up, but I just wonder how much in line Zion Oil has traded with Zion Bank Corporation. That's your homework for the week, people, because I can't help but think that there's some correlation that shouldn't exist there that does. And I believe this is the last one. No, it's not. But we're getting close. So this one is an article from 2002. So you're probably not going to recognize these names. E-commerce West saw its shares soar 76% last week on its biggest trading volume in more than 2 years, after investors apparently got the tiny website developer confused with another company that's planning a initial public offering. Deadwood, South Dakota-based e-commerce trades under the ticker symbol ECOM. On Wednesday, an electronic billing and payment system provider called Princeton Ecom filed for an initial public offering, saying it would seek permission to use the Ecom symbol when its shares eventually start to trade. The next day, e-commerce lightly traded shares jumped 25 cents to 58 cents on almost 18 times their average trading volume for the past 6 months. It was the second such incident this week. Appian Technology, a company with no active business, saw its shares skyrocket Monday to 20 cents from less than 1 cent. Okay, that's a 2,000% return, in case you're counting. After AppNet Systems filed for an IPO, with plans to list under Appian's current APPN ticker, Appion's symbol was changed to APPG. And what this is really to say is 2 decades later from this happening, it's still happening. So, thanks SEC. As normal, they step in after the fact and force a company, because companies get to choose their ticker symbol. And the SEC only forces ticker symbol change, or whoever regulatory body oversees these things, only after these things happen. Now, in line with it, but not exactly, since one of the primary overarching themes of this piece is doing due diligence, making sure you put a buy order in for a company that you actually want to buy with the correct ticker symbol. Now, you wouldn't think that would be difficult, but here we are. And a couple more notes on due diligence. You should probably know if your CEO is a felon. Like, just probably something you should know. Or if they're not a felon. And you should probably know at least where the company you're invested in is domiciled. Just the country. And I've seen a lot of comments in the offshore oil sector about Transocean not going through bankruptcy while the other ones go through bankruptcy. But what they leave out is that they're domiciled and run a business through Switzerland, which has different restructuring laws and implications. And they don't factor that in. I saw this one comment about a person who says that they're bullish on emerging markets and that's where they're trying to focus their investments. And then in the comments, someone says, what about Transocean? You own a lot of that. And so the implication in that is that Transocean is an American, United States company. But it's not. And the comment went on to say, I'm not giving you a hard time, I own a lot of it too. Which is to say that person doesn't even know where their company is domiciled in. So that's interesting. Which means that they probably also have not done much due diligence, 10Ks, recognizing how they recognize currency and so on and so forth. But I digress. So the final one is Nintendo. I remember this. This is what actually kind of cued me on into much of this phenomenon occurring. And when Pokemon Go came out, Nintendo stock rocketed. The above graph shows us just how much of a boost shares of Nintendo saw in early trading in Tokyo on Monday, where the shares saw a rise as high as 23% after it rose about 10% on Friday, according to Bloomberg. Nintendo shares climbed 34% in the past 2 trading days after the release of Pokemon Go. Here's another piece of seeing the market cap just skyrocket. 20 billion to almost 35 billion, along with the volume that just is phenomenal. It's been a wild week for Nintendo Company, which has seen its market value jump by 14 billion amid record volume. Shares began surging last Friday after the release of mobile game Pokemon Go set off a worldwide frenzy, sending the app to the top of charts in every market where it's available. The excitement also triggered a boom in trading, with more than 53 million shares exchanging hands over the past week, about the same amount that traded during the previous 4 months. It actually got so bad and so ridiculous, and that conspiracy theories were coming out, that Nintendo said, hey guys, this really isn't going to impact our financials that much. Like, we've already factored this all in our projections and estimates for the upcoming quarters. And the conspiracy theory was, oh, no, they're trying to talk it down, because CEOs do that. They're trying to talk it down so that way they hit it out the park. It got so bad that they had to release, they had to release a statement stating that the company owns 32% of the voting power of the Pokemon Company. The Pokemon Company is the company's affiliated company accounted for by using the equity method. Because of this accounting scheme, the income reflected on the company's consolidated business result is limited. Blah, blah, blah. All of the above are reflected in the financial forecast ending March 31st, 2017, as set forth on April 27th, 2016. Taking the current situations into consideration, the company is not modifying the consolidated financial forecast for now. The company will make timely disclosure when the company needs to modify its financial forecasts. Which was Nintendo trying to say, calm down, people. It's not as big of a deal as what you're trying to make it out to be. We have a 32% stake, not a 100% stake. And there's subsidiaries at play that are only, joint ventures and or partial ownerships that's embedded in all of this. It's not like Nintendo gets 100% to the bottom line of whatever Pokemon Go does. But that's what a lot of people were thinking. So with that, let's get into the weekly performance of the portfolio. Kinross Gold is doing well. I added some shares in the low 4s. I think that was this week. Maybe that was last week. Tidewater is doing well enough. And then Transocean is pretty much, I think, the same as last week. And then uranium is, well, depressed and depressing me. No, I'm just kidding. I'm not that emotionally volatile. But the fascinating thing I'd like to remark on this portfolio is, well, just the intrinsic volatility of it for numerous reasons. But when OPEC came out at the beginning of the week announcing their cut, oil mooned, got up to $80, $81, shot up pretty nicely. And you could say that was in part, the cut was something along the lines of the Biden administration baiting and switching and not putting a bid under oil by refilling the SPR in the high 60s to low 70s like they said they would do. And so therefore OPEC took it in their own hands to balance the market out. So they did. And the point of that is that on, I believe it was Monday, Transocean ripped, I want to say at one point, intraday high was like 13%, and I want to say it closed the day out on 10%. But subsequently, so you feel really good, and this is one of the dangers of chasing big moves, which I did not do. But subsequently, come Tuesday, it gave up, 5%, and then Wednesday, it gave up 2%, and then Thursday, it gave up, we'll just call it 1%, but we'll call it 2%. So it gave up 5 to or something along those lines. And it went nowhere essentially throughout the week. I think it might have closed up 1% higher. And you have to remember that if a stock goes up 10% and then it comes down 10%, you're actually down in the position from the principal amount initially by 1%. Or, well, not by 1%, but you're still down in the position. If you go from $100, goes up 10%, that's $110. And then if you subtract 10% from $110, you lose, I believe it's $10.10. So you're actually down 0.1%. And that matters. Because if you have big moves up, which are met with equally big moves down, that's not good. But here we are, and who knows what the future holds. And that's all I have for this week. Thank you for watching, and until next week.